Hi, everybody. Thanks again for joining us. We're delighted to have you here today as we discuss how to de-risk or manage the risks around these popular SPAC transactions that we're seeing in the market today. So really delighted to have you here. This is going to be a great conversation. My name is Darren Tashima. I'm a partner at Orrick, Harrington and Sutcliffe, where I lead our insurance recovery practice. I'm a litigator, but also spend a lot of time and have been spending a lot of time recently advising clients, particularly targets in SPAC transactions, understand the D&O insurance issues. So delighted to be joined today with this great panelists. I'm going to turn it over to Mach and Dan now to introduce themselves. Mach, do you want to go first?
Sure. Mach Millett, at its easiest, I'm an insurance broker. At its more complicated, I'm a claims advocate and a go-between for our insureds to try to negotiate the situation around the SPAC transaction and the Dspac transaction at the end of the day. I am a lawyer by trade, former securities litigator, and now recovering as an insurance broker. Dan?
Great. I'm Dan Siciliano. I'm a recovering law professor, which is the worst of all, of course, and still strongly affiliated with Stanford. I was the co-founder of the Rock Center for Corporate Governance. But before that, a technologist that built and sold a company to a large private equity concern. And now I spend most of my time in the governance space, but really on boards. And I spend a disproportionate amount of time on the banking side, but also work with a lot of VCs. So my bias will definitely be from the director viewpoint and even more on the target operating company side. But yeah, glad to be here.
Great. Thanks, Dan and Mach. So just a little outline of what we hope to cover today in our conversation. And we really do hope that this is a conversation, not just among the three of us, but from the audience as well. So you can use the question and answer function to feel free to drop in some questions, and we'll try to get to those as they come up. What we're going to do first is just do a quick overview of a SPAC transaction. Many of you are probably very familiar with the transaction, but just to set the table here, we'll do that. We'll cover some of the key differences and risk exposures between a SPAC and Dspac transaction and a traditional IPO, which I think is something that a lot of folks in our experience are new, and interesting because it is very different than just a private company that's going the traditional IPO route to become public. We'll talk about the different types of claims that can arise and the types of risks that are faced, particularly with these types of transactions, and then talk about other types of risk mitigation strategies, as Dan mentioned, particularly things that directors and officers should think about. So with that, to kick us off, I'm going to turn it over to Dan to give us the overview of the SPAC transactions.
I'm going to take a very specific slice of that, and I'm going to kind of presume, though I think we're going to be open in Q&A to answer whatever, I'm going to presume a certain modest familiarity, and I'm going to kind of highlight some things. If you don't have a lot of familiarity with SPACs, by the way, and the Dspac process, every law firm, Orrick in particular, has some great memos and coverage of it. And of course, you can kind of Google it, and there's new information every day. But let me first talk about it from the target viewpoint. So the SPAC, and particularly the Dspac process, is simply a different way for operating companies to access public capital. The pathway to that moment of the Dspac, which is essentially the merger, that moment of merger, which takes the SPAC IPO that's already happened, which that part is relatively speedy, and we'll talk about that, and it has more openness for disclosures and conversations. But that merger part has something that we won't probably get into in detail, but it has what we refer to sometimes as the Super 8K. That's the moment where suddenly you're really starting to behave a lot like a traditional public company. So that part is hard and messy and subject to all sorts of challenges, and I'll mainly focus there. But this pathway is simply a way to access public markets and public capital, but it lives side by side with more traditional IPOs, direct listings, certain types of secondary offerings actually fit the pattern. So it's just another way to access the markets. It's actually been around a long time, and just for the record, it follows the pattern of its origin story comes out of an effort to avoid the regulatory structure that was there. But move into today's terms, and at least I will say for myself, that though there are risks and problems, it seems like a very legitimate strategy under the right circumstances for getting to the public markets. And I would even say it adds competition to that environment. And, even the chair of the SEC said that, all else equal, it seems like competition is probably good for the market. So I want to mention two particular targets that might benefit from this. And I know we can get into the weeds. So the SPAC IPO is just the gathering of the blank check money that's sitting there. I'm more interested in who they show up to take as a target. Now, as a side note, when a SPAC IPOs, they may not have and should not have, are not allowed to have a target in mind nor to identify a target. That's the process. And when I get to directors' parts, I might tease out some kind of landmines. And by the way, timing and timing pressure is going to be a big landmine, because the process from the SPAC IPO to the Dspac, if you run out of time, that's where we see a lot of problems. But there are kind of two companies, I think, roughly speaking. There's other exceptions that fall into the likely target of a SPAC. And the first is a company that probably would have IPO'd, was close to IPOing. Its profile is, pretty traditional. Maybe it's a little smaller. Maybe it's got a higher growth rate, whatever the case may be. But you can see from where it sits a pretty clear line of sight to a traditional IPO. And for whatever reason, they're not going that path. That's one category. And I call that kind of like, if you're thinking about from the venture space, post Series D, right? Maybe if they're doing great, post Series B or post Series C, and also probably targets for large private equity players, right? So the same folks would have been attracted to that. If on the other category, though, is a little bit more like an earlier stage company, maybe it's just post Series B. And I'll say from the target's viewpoint, they see this SPAC phenomena happening. They're like, that would be really cool if I could skip Series C, D, and E and get all that capital and just kind of grow. And as it happens, it is worth keeping in mind that this is a pattern that we already see in the public markets, and by and large, we've grown comfortable with. And it's the biotech and the biopharma pattern, where there are companies that go public that there is great uncertainty about whether or not they will ever be viable. And they are pre-revenue, they're a long ways from provable revenue, and yet the markets have gotten pretty good at understanding what that looks like, right? So these two buckets matter a lot in terms of the speculative nature, the risky nature of the companies themselves. And I want to just throw that out there, and then I'll pause now and we can go over some stuff separately and let Mach jump in. But I actually think it's worth keeping those two things in mind. And I do want to say, my opinion, neither of those is wrong to access this source of public capital. They just come with more complex and different disclosure issues, arguably. If you are one of those, post Series B-ish, long way from traditional IPO type access, when you get to that Dspac part, and if you're the target, they arrive to you, frankly, when you get to Dspac, you have to think hard about the fact that those disclosures are going to be rife with potential for unhappy shareholders later to look back and say, wait a minute, that wasn't right. Just the potential of a problem is higher because there's a higher potential because of the risk and speculation that in month 6 or 12 or 18, you still don't have revenue. Things are going badly. So it matters even more than it might be the case in a traditional sense, where it's that other type of company that might go public. Let me just pause there because I threw out a bunch of stuff, and Darren and Mach, I'll let you take it. I do want to come back to directors, what directors might think about if they're being approached. There's a big sucking sound in the world of SPACs where they need directors. And so I suspect a lot of directors are getting that phone call. Maybe we can talk a little bit about that.
Sure, and I think one of the reasons why this is so top of mind for a lot of folks these days is the sheer volume of SPACs and de-SPAC transactions that we see right now and in the pipeline. So to date in 2020, we've seen about 160 SPACs go public. That is a huge increase from last year, which was already a huge increase from the past, but it's not as if SPACs are new. SPACs have been around for a long time. And one of my first introductions to SPACs, unfortunately, was litigation for a SPAC 12 or 13 years ago when I was still on the litigation side. Here at Marsh, we now see probably somewhere between 30 and 40% of all SPACs in terms of helping them with the D&O process. And we'll probably have 25 or 30 in line right now that are getting ready to list in one stage or another. And then on the Dspac transaction side, probably another 30 Dspacs that are in various stages. So the volume is very high. The timeframes can be pretty tight. One of the advantages of the Dspac over the IPO is how quickly you can get it done. Quick is great, but it also creates some time pressures for the other pieces of the process as well. Darren, I don't know if you want to sort of intro in on the insurance pieces of this as well, or how you want to transition next.
Yeah, sure. Why don't we can just jump right into some of that insurance piece of it and come back to, and then Dan, please jump in about the the director perspective. Just building off of the comments about where particularly the second bucket of potential SPAC targets is, and one thing is you hear about the process going quickly. One of the corporate governance issues that needs to be addressed as they get ready to go public is taking a look at their insurance program. And I certainly see this where if you think about your private company D&O insurance, and I'll get to the different types of insurance in a second, this may well be, for example, a policy that was procured 8 months ago, 10 months ago, before this opportunity arose. And there's an application that gets filled out, and asks you what you're anticipating in the next 12 months. And it very may well be the fact that you said no when you were, talking about a big transaction. So that is definitely something to keep in mind and be aware of. And one thing that I've done and working with Marsh and others is we can help those targets, kind of make more robust their insurance coverage in advance of the close of the transaction. So you have this private company insurance in place. Let me just talk about, I think to put that in context, there really are three insurance policies, D&O insurance policies to think about when you're thinking about a SPAC and frankly, the Dspac transaction. So first is the private company D&O insurance policy that applies to the target, which I just mentioned. The second is the SPAC itself. Once it is public, it will have a D&O policy as well. And those two policies, they exist during the time up until the close of the transaction. And then typically they are put into runoff. So the policy ends, it is going to be replaced with a public company D&O policy. And those two private company policies are placed into runoff. So they provide tail coverage for a claim that comes in the future, alleging a wrongful act that happens pre-close of the transaction. The public company policy takes coverage for the risks going forward. And what we're seeing typically, what I've been seeing more recently, the market and much, please chime in here with your views too, is insurers being reluctant to issue any prior acts coverage, which means it's only going to cover claims that allege wrongful acts, misstatements made after the close of the transaction. And if that's the case, you can see there's going to be this concern about where does a claim that maybe alleges misstatements that happened before the transaction made by maybe some of the same officers and founders of the private company that's now public, where does that fit in terms of insurance coverage? So that's, I think, really the issue. Let me just pause there. Mach, are you seeing kind of things similarly on your side in terms of the availability of public company coverage for prior acts?
Yes. So I think reluctance comes in two forms, either a true reluctance to do it at all or a fairly significant premium attached to the idea of doing that sort of go forward, no prior acts exclusion sort of coverage. So it's a conversation we certainly have with our Dspac clients about whether or not you should run off the private company D&O or if you should try to continue that forward through into the public company. But there are some limitations and some ramifications from the insurers in terms of trying to do that. I do think it's interesting if you're sitting there as a private company now or a private company board member thinking that a Dspac transaction might be in your future. I think it's important to understand that you can't just wait for the insurance piece of that until the future. So if you're really seriously considering that now, there's some factors to think about for the private company D&O insurance. First and foremost, I think of there being sort of 4 or 5 things that you should take a stop and think about, particularly if you have a renewal coming up, but even if you are midterm. One, do you have enough insurance in place? Is your limit appropriate if that is one of the potential things that you will do this year? Do you have Side A insurance in place in terms of asset protection for the individual officers and directors on top of any sort of ABC insurance that you might have in place for the entity? Is there a public listing exclusion on your private company D&O policy? And if so, would it apply to claims that might come out of a pipe transaction or the reverse merger process or what have you? Do you have affirmative roadshow coverage for what you're going to be doing as part of the reverse merger? And then finally, do you have pre-negotiated runoff pricing for your private company D&O? Because if you don't, these days in this insurance market, when you get to the point of wanting to do the transaction, you may not be overly excited about the pricing that you are given for that runoff cost.
That's a great point, and Mach, thanks. Just to pick up on that, a couple things. One, Mach mentioned the roadshow coverage, and so many private company forms have coverage so there's a securities litigation exclusion in all private company policies. They have exceptions though. Some policies will have an exception for this doesn't apply to claims where there's not a registration requirement, SEC registration requirement. And they also say this exclusion doesn't apply for roadshow activities or any activities that are, any alleged wrongful acts that happen during the lead up to a potential IPO. And, we would certainly take the position that exception should be in place. And in the event there's some type of claim in the future that alleges some misstatement by the target in connection with the sale of securities. So that's certainly helpful. I have also seen private company D&O insurance policies where, and again, this would be for a company that maybe wasn't contemplating a transaction in the future, and their securities exclusion just says we don't cover any claims related to securities. And even though these claims may not be, regulated by SEC rules, I suspect an insurer may take a position if, they got an application that said we don't contemplate a transaction in 12 months and you didn't have this carve out that's available in the market. I could see an insurer taking a position that there would be no coverage for a later claim. And we'll get into a bit about what those claims could entail, or kind of, what they could be alleged, but it might be, for example, an alleged aiding and abetting claim from a SPAC back to a target in the event of some misstatement, and someone is challenging the transaction that's been disclosed as in the works. So I think that's really important to point out. And then the other piece I'd mention in terms of to pick up on Mach's point about coverage and how it's getting more costly, I've definitely been seeing that with these private company policies where they are anticipating perhaps these types of side C securities claims against the company, the retention is much higher. So a public company policy right now, we're seeing very high retentions, probably $15 million retention, $10, $15 million retention, to be contrasted with a private company policy, which, might be $100,000, $250,000 retention. But for the side C coverage, if they think they know you're about to go into a Dspac, they may charge a much higher retention, less than 15 million, but they're going to be pricing in that risk both on the premium side and also their attachment point to the risk.
And I think in general, go ahead, Dan.
I was going to say, it's probably worth maybe backing up at this point, and we can kind of dive back on details, just in case. I know there's a variety of different experiences for those attending. Maybe describing a couple of the phases and then pointing to the parts where the directors, and not to be boring about it, but the D&O insurance is like a very important part of it. But in some ways, there's some other things that can be done ahead of time that both reduce overall risk and also reduce the negative impact, even when you have to invoke D&O, right? So I might remind us that there are different players with different incentives in this narrative. And by the way, I subscribe to the notion that this is actually a permutation of an asset class. A lot of people would say this is just a different path to IPO. That's a fair analysis. I would say it's a different way of characterizing a type of private equity, right? So if you remember that there are sponsors in this story. So the sponsors are the ones who spin up the SPAC. They have, they make the effort to both do the SPAC IPO to find the institutional investors, find that capital, and then move forward and try to identify a target. And they actually are one of the few players at the early stages who have genuine capital at risk, but also have tremendous upside potential. So you can kind of just Google that and find those stories. But that is differentiated from the institutional investors, of course, who are putting money into the SPAC, but have a period of time in which, in many ways, it's roughly a free option, right? So it's it's money that's parked. It generates a very, very, very modest return, but it's not technically zero. And then they can get their money back. And that's important because they don't have money at risk. And I say this because if you're a director looking at or being asked to join a board, there's a couple of things to keep in mind. So one, so far, a lot of the problematic litigation arises with a fact set where the SPAC is running out of time. So when the sponsors spin up the SPAC, they either get 12, 18, or 24 months. It typically can't go past 2 years, and they need to identify a target and then deploy and do the Dspac within that period of time. If they don't, then they have to give back the money to the institutional investors. And this is worth keeping in mind because if you've put your own capital at risk, you are looking at this upside and you're really endeavoring to try to identify a target, and the kind of markets are flooded with a lot of SPACs. One fear or one theory, which I'm not sure is in evidence yet, is that there's all these SPACs chasing limited target opportunities. I'm not sure that's true, but if you thought that might be the case, then there's a risk as that SPAC is running out of time that they go for a target that might be lower quality, there might be problems, they might rush towards the end. So that's, if you're a director, one of the things you want to look at is what is the time frame? Does this SPAC have the ability to do an extension unilaterally, perhaps? If they hit the 18 months, can they add 6 months? Because pressure creates a rush, which creates problems. And then maybe it's obvious, but you want to look at who else is going to be on that board. Like, and do they have domain experience, right? So there's this star power function for SPACs at the onset, because if you have a star, then people might flood in and say they might be able to find the great target and do something wonderful with it. But the more practical issue is in the obvious domain, once perhaps the target's even identified, do the directors that are assembled have true domain experience? Because if they don't, they're much more likely not to be able to review the S1 correctly, to be able to understand the disclosure. I mean, you're more likely to make mistakes. And then that brings you to the lawyering. And the SPAC IPO is described as quick in 8 months, and the financials are easier, and that you can talk about stuff in the way you can't in a traditional IPO. That's true, but the Dspac part is like an IPO, a merger, and a complicated additional 8K combined into one. It's actually pretty messy and a lot of moving parts, and you're probably in a little bit of a rush. So I want to say the lawyering really matters. And kind of like with surgery, the advice my doctor friends always give me is whatever you do, pick the doctor that does it all the time. Like you want lots of them done, just like you're getting the same thing. I think it's true with the lawyering. So whatever firm is involved, if you're a director looking in, are they in a rush? Hopefully not. You know, are the other directors people I'd want to do business with? Do they have the domain expertise that makes sense? And then third is the lawyering that's deeply experienced, not just in M&A and not just in IPOs, but actually in Dspac, right? And if those three are there, I think just by the numbers, you've radically reduced your exposure. And you still need the D&O. Like, that's always my last point, right? But not my deep expertise. I just throw that out there. It's sort of common sense, but I think people can get caught up in what is, but let's call it a modest rush in a direction of a particular vehicle, which I think is what's going on.
So Dan, I'm curious. First of all, we're certainly used to being the tail and not the dog from an insurance perspective. Yeah. So used to that. But the question: how do you think about the balance of the tension between not being able to have an identified target already, but also having a good sense that you're going to be able to do a good deal within the first 12 to 18 months, and sometimes these days much faster than that? How do you look at that balance?
So I think it's the same dynamic that occurs on the buy side for private equity or other institutional buyers. And that is, do you have the compunction and the ability to walk away if you don't find what you need that meets your parameters? And this is certainly, I do a lot of work with Heroic Ventures, the wonderful early stage startup, great guys, and they've been at it for a while now. And they have such discipline, right? You get excited about something and then you lose it because someone else swoops in. I'm a big admirer, but call it Sequoia. Sequoia comes in and says, we will give you everything you ever dreamed of. And you're like, oh, darn it, right? And the third time that happens, you're like, okay, whoever shows up next with this idea and this market strategy, we're buying them come hell or high water, no matter what. There's a terrible view. And I worry that the SPACs that have real discipline, if you don't ever see a return of funds in a hot market, then that's actually a bad sign, right? So I think there is a real balance there. By the way, what helps make it work is the star power might attract capital, right, at the SPAC IPO, but it also attracts targets, right? There's so many parallels to kind of this combo of VC and private equity. I guess it's obvious, but like deal flow, the ability to look at targets, to get access to targets, the target saying, I want that one. They seem like really, high powered. That actually helps a lot. So whether we like it or not, whether we think it's like meritocracy oriented, the star power, that creates better target flow, and there you are. But I will say there is some evidence that there could be risk of settling on the part of perhaps, I don't want to call them lesser funds, but funds with a little bit less access, or SPACs rather, with a little less access to the perfect targets, where they're like, we got to deploy this capital. Otherwise, all the work we've done is for naught. That's where I think you might end up with challenges. And final comment on that is that's different from a SPAC going out and saying, we want to take the best risk adjusted bet we can make. So don't misunderstand. Like, I'm all for someone showing up and saying, you know what, these guys closed a Series B. They're 2.5 or 3 years away from real revenue, but we want to make that bet. We want to disclose that. We want to bring the right board together. We want to do, and it's a big bet, but you know what, on a risk adjusted basis, we think this is a great return. And I will note, theoretically, this is potentially a very good thing for the public markets. One of the trends of the last 20 years is that we may never see a Microsoft again, right? Microsoft's returns in the public market were like so radical in terms of the multiple, but now those returns tend to accrue to the private investors, right? So Airbnb isn't going to have 1,000x return. I'm a big fan, but they're never going to have 1,000x return. That'd be almost impossible once they go public, right? Because they're so large now. This early stage company SPAC bet is an opportunity, if appropriately disclosed, right, and everyone understands, for the public markets to experience what maybe they once had before, when we could bring companies to market with, 40 million in annual revenue or 25 million in annual revenue. So I actually think it's a good development, all things equal.
Big fan of Airbnb as well. I'm a host and a regular user. So
I'm a total regular user. Yeah.
At least until recently. Little less now, but. So maybe it's a good time to talk a little bit about some of the claims activity we do see in this space. And I mentioned that my introduction to SPACs, unfortunately, was a claim. So back in my litigation days, there was a SPAC that made an acquisition, and then after the reverse merger, the public company stock went down, and the lawsuit that was filed, and this is sort of the traditional, I think, perceived potential litigation risk, stock went down, and the shareholders brought suit saying that the deal never should have been done, that there were misrepresentations made to them to stay in the deal and to approve the deal, and that it was only done because the investment period was coming to an end and the SPAC didn't want to give the unit holders money back. They wanted to go ahead and do a deal. And that sort of 2020 hindsight litigation, I think, is still the biggest risk here from a sort of severity standpoint. We might be seeing a lot of volume right now in terms of some of these kind of strike suit type cases, questioning whether or not the deal should be done and what have you. But the big cases are going to be those after the reverse merger claims where the stock goes down. But these days, we are seeing a fair amount of claims activity. I don't think it's necessarily as much as maybe gets publicity in the news and what have you, much less as potentially severe as the news would have you believe. But we are, we've seen the two announcements, and Dan and Darren, I'd be really interested in your thoughts on this. We've seen the announcements from the SEC about potential additional scrutiny on SPACs. That's one bucket that folks worry about. We have also seen a couple of post-reverse merger, stock didn't do so well sorts of cases, including one or two where there's fairly serious allegations about the accounting that was going on at the private company and thus got integrated into the public listing. And we have actually seen a case or two during the investment period for SPACs. They're pretty rare, and I think they're pretty unique in terms of what they are, but they relate to the due diligence that is done on companies and whether or not information was used in a way that wasn't appropriate under the NDAs and that sort of thing. But they're pretty unique and pretty infrequent. So The folks that I work with on the insurance side are not big fans of the idea of SEC scrutiny. They've seen that in the private equity space and what that ended up meaning with those SEC investigations in the private equity space. I'm curious, Dan and Darren, what do you think of those announcements? How do you take them? Do you view them as a similar sort of threat, looking at, disclosures and returns and what have you for SPACs, the way it happened with PE?
Let me throw out a short answer, which is it's a certain inevitability, right? It's the job of the SEC to investigate places where problems may happen. This is obviously a noisy part of the market that's growing very rapidly. It's only prudent for them to enter in and frankly sharpen their claws a little. The question that I tend to answer, and I think there's actually a relatively satisfactory answer, is how does a prudent company, a prudent board, like what do you do in light of that change by the SEC? And how do you avoid perhaps an unfair burden or unfair scrutiny? Well, there's no simple answer, but the strategy that you can deploy is what we call the wildebeest strategy, which is you don't want to be at the front of the big crowd and you don't want to be at the back. What you want to be is kind of in the safe middle, right? And I hate to say it because it's kind of boring, but it's kind of the 3 P's, right? Which is you want to have process, and lawyers love process, but process serves you in corporate governance and in the SEC scrutiny world and the shareholder litigation world. Process. Because again, you're allowed to make business mistakes, but only if you've perfected the process. And then what I would call paper, it's part of process, but it deserves its own call out, which is you need to engage in the appropriate, finely tuned, everything from disclosures to filings that, mistakes in that area can really trip. And then finally, prudent diligence. Like if you're in a hurry, haste makes waste. Like you're probably going to make more mistakes. Everyone makes mistakes. Business is hard. We make mistakes, but you're going to make more mistakes on average if you're in a hurry. And so prudent diligence really serves a strong purpose. So I would say it's inevitable. You just got to acknowledge it instead of complaining about it, and then figure out how to do those 3 P's to put yourself solidly in the middle, because the SEC doesn't want to pick on like folks doing the right thing, obviously most of the time, unless something spectacular happens. But as scrutiny increases, the outlying wildebeests, they get taken down by the big lion. So,
and that's a great point, Dan. And I think also just thinking about it in terms of the directors of the private company, right, who are may trying to then become part of the public company also, as they think about the lead up to this. It seems like it's a safe assumption to just realize that there's just going to be more scrutiny, right? And meritless lawsuits are filed all the time. And that's kind of the cost of doing business now. It's where we are. So thinking about, to Match's point about the amount of insurance coverage you have, and really thinking hard about that private company insurance. And Mach mentioned Side A, which is the coverage that only applies to individual directors and officers in the event the company is unable or unwilling to provide coverage, for example, in a derivative suit. I think is really important, and maybe something that if you were a director of a company that has IPO'd before, may be coming with it from a different perspective, thinking, okay, well, we were that Series D company. We had developed a very robust D&O program that had towers of insurance, Side A up, to be contrasted by what could be the case of a target that, maybe has less than $5 or $10 million of D&O insurance without a Side A program. And the risk profile is just different, not because of anything the company's done, but just in this environment of kind of higher scrutiny, people wanting to bring a claim, post-transaction, to really think about the benchmarking. It just may be different. You may want to think about what your risk profile is. It's not a private company of a certain valuation, but it's a company that's going to be going public. And I think that's something to keep in mind if you're a director of the target as well.
Yeah, and Darren, you raised this issue of like D&O and risk mitigation maturity, right? Which is less in evidence in a earlier stage company. That applies to everything, right? So accounting, audit, quality maturity, like that applies across the whole spectrum. And I would point out that for those earlier stage companies that are in that other bucket that are making the great leap, right? Which I think is okay on a risk adjusted basis. it is important for those directors to recognize and not conflate. So people hear the SPAC IPO is a lot less onerous. Yeah, that's the SPAC IPO. That's not the Dspac, right? And so I think they need to be investing as soon as possible. And there's always good practice anyway, because M&A is the most common exit, right? So in M&A, this helps increase value. You should be able to spin up a data room that's pristine and beautiful. You should be able to have, financial statements that they're not going to have 10 years of perfect auditability because you haven't been there for 10 years, but they should be ideally audited or immediately auditable, like flip the switch, pay that money, and on and on and on. So this idea of, am I a mature acting in terms of what I have in place company, even though I'm like a post Series B? That's a choice, and it takes months to spin up to that, but it's a good investment because, by the way, if you end up not being a successfully, outcome target, maybe there'll be an M&A knock on your door of a traditional sort. And I can tell you from experience, a really clean, checklist of all of those things serves that kind of company very well in M&A, right? And so that's an investment that I think, as opposed to the kind of Series D-ish, they tend to have that in order because they've been chit-chatting about IPOs for a while, right? Whereas the post-Series B, unlikely. And I don't blame them. By the way, those entrepreneurs have a lot of other stuff they gotta do just to stay alive. So it is a change of mindset.
I love the analogy of the wildebeest as well, and made me think of an advertisement I think that was out about 6 months ago, and it might have been for an insurance company, but there's a herd of wildebeest charging across a raging river, right? And it's one thing to be in the middle of that herd, right? It's probably protective, but then there's one wildebeest who starts to wander off to the left, and the other wildebeest says, "Where are you going?" He said, "I'm going to go take the bridge." So I think lots of people are trying to figure out what's the bridge across the raging river for these SPACs, right? And you mentioned due diligence, and I'm the boring guy who keeps bringing it back to insurance, of course, since that's what I do. But we do a lot of insurance due diligence for the SPACs in this process as well to make sure that the target company has done this consideration of what insurance to have in place and is well set up in that regard. And then the final piece of insurance, which most folks have never thought about really in this process, but gets thought about all the time in the private equity space for deals, is reps and warranties insurance. So transactional risk insurance. And can that be used by a SPAC in this context so that if you do have that litigation post-reverse merger, that 2020 hindsight, if nothing else, it's another bucket of insurance that can help deal with that potential situation.
And I have a question for you, Mike. Is that possible? Like, again, it's been 5 years since my company exited, and at the time, the reps and warranties insurance was a little bit less mature of a market, but we deployed it in a Thoma Bravo acquisition, and it worked wonderfully. Like my deal before that, we had all this in escrow. Like there was a lot of escrow, and I'm like, right? You work for a long time. You're like, wait, what's the net? And I thought that was like a wonderful, for me, innovation. I'm like, yeah, does that apply? In this particular, can you do that in this context? That's interesting.
It can be used in this context, and it's a little bit different because it's a public style deal, which in its first instance raises some hurdles, but it can be done. There definitely has to be some consideration with counsel as well about what sorts of disclosures, if any, need to be made about the fact that this reps and warranties policy is going to be put in place. It can put one group of investors in a different situation than some of the post reverse merger public investors as well. So certainly something to think about from not just the insurance piece, but also disclosures and what have you. Another piece of sort of the how do you take the bridge instead of charging through the water that we had talked about earlier is sort of backtracking to one very simple thing that you can put in your S1, which is an exclusive federal forum provision, and make sure that if worst comes to worst, if you're going to get sued, at least you have chosen where you're going to get sued at the end of the day, and you've put it in front of a court that you feel comfortable with, right? As opposed to ending up in a small state court, goodness knows where. So it's become almost automatic in IPOs these days to put an exclusive federal forum provision in there, and it has been upheld now in Delaware and in California that those are effective. And so I think it's a good choice to make. Very basic first step towards, Dan, doing some of the things that you're talking about. But I think from the insurance perspective, the underwriters really do want to try to differentiate between different SPACs and between different Dspac deals, and being able to have a presentation to those underwriters where you lay out the controls and the processes and what have you that have gone through to explain we are not doing this just sort of as a knee-jerk reaction because the investment period is coming to an end. We have done everything that we should do, and this is a good deal, and we're ready to go. And yes, there's risk, but there's risk in everything. Right?
Yeah. And I'm obligated to say, we refer to that, at least in my circles, as the Grunfest solution, the federal forum selection. But I joke that was Joe Grunfest's very valuable apology for having given everyone the idea of withhold the vote campaigns on the shareholder side. So, he balanced it out with the federal forum selection.
Mach, I wanted to just pick up on one other thing that you mentioned, and that's the presentations to underwriters. From your experience, I'd be interested to hear if you're seeing something different with these Dspacs, just the presentations and the level of scrutiny that a target company and the proposed public company scrutiny they're facing when they're trying to access public company D&O insurance. Has that been different than what you maybe see traditionally?
So I would say that the scrutiny has increased throughout the process. So for the SPAC and for the target company, we are seeing far more scrutiny from the insurers about which are good risks and which are less good risks, and that applies to the SPAC in the initial instance. In the past, typically the SPACs were underwritten solely off of the S1, so you'd get the confidential or the draft S1, and that was the underwriting submission. We are seeing more and more these days a desire from the insurers and a willingness from the SPAC Ds and Os to actually do an underwriting meeting and a presentation as part of that, if there's a sense that it would differentiate the SPAC, if there's a particularly strong sponsor team, story behind the SPAC, what have you. When you get to the Dspac transaction and contemplating the reverse merger, there is nothing more important than that meeting. The papers are nice and what have you, but to have a really robust, strong meeting where the underwriters can ask questions and what have you is huge. And we do that every single time. And to your point about scrutiny, the market has spread a lot too. I think there used to be, a half a dozen insurers who were really in the mix for new public companies. And that has changed fundamentally over the last 2 or so years. I think we generally invite 50 or 60 insurers to those sorts of meetings now, because you really need to have everybody come to the party, because ultimately you want to find somebody to dance with, and it's getting harder to find a dance partner. I will say that.
Great. Thanks much. Well, I know we're got about 15 minutes left here, and wanted to make sure we have time for folks that are joining us to ask any questions using the Q&A box. So we'll just pause here. Please just feel free to jump in.
I have a question while we're waiting for a couple to come in from Ash. So can you describe the role that you play, that a broker would play when there is a claim and the underwriters, the fundamental insurers kind of we're not sure how that happens. You kind of made an allusion to that in your introduction, right? And I'm wondering how that really plays out in a SPAC scenario, but just generally. I mean, what does it mean for me to have a claim? I'm a director, chair, whatever. We have a claim. I notify obligatory fashion the insurer. They say reservation of rights. We're not sure. And I'm like, what? No, this was really covered. I'm sure it was. And I call you. What happens when that happens? Is that I assume I call you, or I probably call a bunch of people, but I probably call you.
No, you definitely call me, and I am part of a group, among the other things that I do at Marsh, of what we call claims advocates. So in our financial and professional unit, we have a team, a claims advocacy team that's made up of 15 lawyers. We're all former litigators, coverage lawyers, what have you, sort of like an in-house law firm to help you try to make sure that the insurance companies actually follow their obligations under the insurance policy, such as they are, and make payment and negotiate a lot of things that are always gray areas as well, like allocation of defense costs and who's covered and who's not, and how much an hour can the defense lawyers charge. All of those sorts of things. So it is a really important part when you're thinking about the future, is thinking about, if we have a claim, do we know that we have a dedicated resource to help with that? And so it is hugely important, and a place we've made a real investment at Marsh.
Okay, that makes sense. Last question before we turn to the others, which is maybe for Darren, but also for you, Nash. So there was this allusion to the minds in the questionnaires and the pitfalls of that. Do you advise retention of counsel for the purposes of answering the initial, D&O policy questionnaires, or is that what the broker does? Like how paranoid should the company and the director be about like getting that exactly right? Because it feels like one of the places where there's some gotchas that appear that frankly could be quite innocent, I think. What do you advise?
Yeah, so it's a good question, Dan, and we do get involved pretty early on, as I mentioned. Even though I spend my time, representing policyholders when there's a dispute over a claim, and have worked with Marsh and the claims advocates there as well. I think it's helpful, you're often to have not necessarily coverage counsel, but counsel helping you kind of think through and answer those questions, because often, your corporate counsel is going to have a lot of information too that can just help with that process. But I do think it's important, for companies to be thoughtful around answering those questions. D&O questionnaires are becoming pretty straightforward. You see a lot of the same questions. I spent a lot of time advising clients on cyber policies, which are getting, ever much, more complicated and rigorous in the underwriting. But I think even with those D&O applications, I do think it's important to kind of just really think about it and, either run it through your in-house legal or your outside counsel just to get a pass on before it's submitted.
Thanks.
And I agree with that. I think that if misrepresentations are made in the application, judged by 2020 hindsight again, that can have some ramifications from a coverage perspective. And we've seen a bit of that in actual claims. I do have a couple questions in. Yeah. Maybe we should address some of these. The first, we are seeing a new sort of investigation or claim arising as soon as a SPAC M&A transaction has been announced, well before it has even closed. What is driving this? I have my own thoughts, but Darren or Dan, maybe you want to start with that.
This is definitely Darren's arena.
Yeah. Well, I thank you for this question. And, been seeing that also, and I think Mach alluded to this as well. Some of the ones that I have seen are shareholder, SPAC shareholder claims that the valuation wasn't correct. And, as a defense lawyer, I've got a certain view of these claims, right? But I think it's probably driven by the market and what you're seeing in terms of this dynamic of, potential targets, SPAC opportunities for, the right investment, and then just making sure that the valuation is there. And then I think it also depends on how the particular transaction is worked out. Some of the allegations are around the shares, that go to the founders, for example. So Mach, what do you think?
Also, as a former securities defense lawyer, my automatic reaction is, what's driving it? Well, the plaintiff's lawyers are driving it. There's such high volume in this space that it's grabbed a lot of people's attention, including the plaintiff's attorneys bar. And the securities bar is quite well organized, not as well organized as it used to be, but there's still some major players and they have well organized operations. And so they are seeing this as a potential growth area. I will say we've seen some complaints where it's clearly a cookie cutter complaint. They've forgotten to remove the name of the prior company they sued and what have you. So it kind of wonder sometimes how serious these really are, or are they just sort of like the take private bump up suits we've seen in the past in this space, where they're really kind of just a hold up. You got to pay some plaintiff's attorney's fees, maybe a couple additional disclosures, and right. And away it goes.
The next two questions, I wonder if we can combine them. And I want to add my urgency to this question, which is I'm a finance guy. I chair a fairly large bank, and I've seen D&O analysis and stacks that are more complicated than your average waterfall analysis for the things of the company. And it really is hard, I think, to figure out how much you need. And it suddenly has gotten even harder because it's gotten really expensive in certain cases. So is there a quick rule of thumb that goes beyond you'll need to consult your broker, your lawyer, and your risk people? But how can you navigate that? I totally share those two questions.
Yeah, so the two questions are really around how do I set the right limit as a private company unicorn, and how should I be thinking about it from a director's perspective? Sometimes we get to the point of the conversation where we presented all the metrics and all the data and the claims examples and benchmarking and everything else, and the the insured is still sitting there looking at us at Mars saying, yes, but so what is your recommendation? And there is a bit of a moment of awkward silence. There is no doubt that these days it depends not only upon your risk tolerance and risk aversion sometimes in terms of how much you're going to buy, but it's how much you're willing to spend too. So in the old days, it was sort of like, I'll just keep buying because up at the higher limits, it's only going to cost me, $40,000 per million. So why, I'll buy as much as I can. I think that has changed because of the cost. A lot of people are more closely scrutinizing how much makes sense. And at the end of the day, the best that you can do, I think, is you combine benchmarking, which is what other people in your situation buy, with data analytics, particularly on litigation. We have an ideal model that we use a lot to sort of say, here's how likely litigation is, and here's what it would likely look like. And then finally, claims examples, talk about your specific situation. What do you think either exacerbates or limits your potential exposure? And then, but at the end of the day, we will make our recommendation. And it might be a range, but we will make our recommendation, and ultimately the insured has to decide. And I think in conjunction with counsel should be part of that conversation, absolutely. And bringing some sort of reality to the conversation about, folks may think they have zero risk of litigation, but that's probably not the case.
Right. And I would just add, we get this question a lot also, and it's never a satisfactory answer, as Dan, you were alluding to, in terms of, well, it's, it depends. A couple thoughts on things you could work on, though. And there was a question about if you're, thinking that this might be a Dspac opportunity in the next 12 months, do you start to bump up your limits? I would recommend that you take that opportunity to really look at the policy and, talk with your broker and coverage counsel about, is this the right coverage form on the primary policy? I mentioned that there are different forms, some more robust than others, that are targeted to companies at different stages. And I think having that more robust, I'm a well-established private company, maybe with a public company risk exposure, is a good way to think about that. Getting that primary policy in line first. You can add on, may cost you more, but you could always add on the excess layers on top of that. So, I think that's important. And then also to the point about benchmarking, I do think if you're a private company, Dspac target, the benchmarks have changed, in terms of, well, I'm a, private company in this space with, at this valuation, as opposed to I'm a company in the space that's, a public company. And I should add, actually, one other piece of this, not on the limits, but just the types of coverages. I'm seeing that insurance companies for those high growth, fast track private companies, they're often being moved toward a public company D&O form anyway. So there's a lot of, at least from my perspective, there's a read on what the exposure is for those types of companies, and they're being seen more as potential exposure litigation targets, like public companies are.
We'll say sometimes you need to be careful what you ask for. We're having a lot of questions come in here, so if we don't get to some of them, we will certainly try to respond.
We're happy to.
There's some we should
have started.
Definitely answer afterwards. Yeah. So
we're happy to chat.
I am interested in this one question here in particular, and it actually came in next, so we may maybe see if you guys have some thoughts on it. Which is, any thoughts on special liability for non-North American targets for a Dspac? We certainly work with a number of SPACs who are non-US domiciled, but going to be a US listing. Has some interesting ramifications for the insurance process. Many insurers won't write that out of the US. You have to go through Bermuda or London because they're organized in the Caymans or what have you, that sort of thing. But curious if you guys have thoughts on, is there any sort of different process or different considerations for a target that is non-US?
So I don't know enough about that to answer. So I'll give the answer I give anytime I have that kind of question or a director has that. And I say, let's find specialized counsel to give us the answer. So I mean, by the way, if you're a director, a candidate confronted with that, I will remind everyone that it's not a safe harbor, that's overstating it, but the reliance on third-party experts in the augmenting of your decision-making is always a good best practice. So I have no idea. Darren, do you know?
I don't know. It's a good question.
It's a great question. It's a great question. I don't know.
Yeah, so I think from my perspective, you're going to be a U.S. listed company, and you may be a foreign domiciled U.S. listed company by the time you're done with the Dspac. You have sometimes in some countries different indemnification laws for the Ds and Os. So, for example, if you're Irish domiciled, those laws are quite different from the U.S. So those are considerations that need to be taken into account. And U.S. courts, you guys disagree with me if you feel differently. U.S. courts have certainly made it clear recently that they have no problem with foreign domiciled U.S. listed companies being sued in U.S. courts. So you should be ready for that reality as well. It's not necessarily going to be a home game for you. It may well be a U.S. litigation situation.
Yeah.
So I know we're almost at the top of the hour here. There are some other questions here, and I guess I would say that for folks that we don't get to, please, you've got our contact information. Feel free to send us an email. Happy to chat and answer these offline. Is there anything else, Dan or Mach, you think we can cover in a minute?
The view on due diligence around retail investor on SPACs very quickly, and only with a little bit of snark. I think it's a great question, but the reality is that at the SPAC, the retail investor has very, very little information other than the star power, the plant. There are alternative ways to get at that same opportunity through private equity, perhaps, right? So it's kind of a private equity play where you're betting on the people who can be smart enough to actually engage in a smart deal. I would suggest for the great leap company bucket that we described, the post B, in some ways, if that's what you think that SPAC's going to do, you're better off waiting and doing a diversified portfolio strategy as a retail, post Dspac. And yes, it could be hot, and yes, you might miss a little bit of a pop, but the real advantage in the public markets in that story is you have a company that's going from relatively early stage and might experience tremendous growth. And those have not been as available in the public markets as in recent, as they once were. And so that's the retail opportunity. And I teach finance, and I always say the only free lunch in finance is a genuinely diversified portfolio. So in principle, I'm kind of against retail investing in the SPAC level. Tony, I apologize for the not satisfactory answer in that way.
And I'll just take one other question real quick because it's near and dear to my heart, which is, do I see any light at the end of the tunnel, either from a D&O premium retention reduction perspective or reduced litigation liability risk for SPAC issuers? It's a very small light right now. There's a lot of difficulty in the market in terms of this right now, but I think there's a lot of hysteria too out there about, insurers are pulling out and what have you. I don't think that's true. I think what we're having perhaps an overcorrection from the insurer's perspective in terms of limits, premiums, and retentions. But what we need is some new capacity in the marketplace from new insurers, and also it'd be nice to see some positive decisions on some of this litigation as well. Both of those would help. So those are potential lights at the end of the tunnel. And all you can do is sort of monitor it day by day. This market changes day by day, week to week, very quickly. So keep a really close eye on what things are going on and have good advisors. That ultimate cop out, have good advisors.